Hello, Gary Merzinski back again, and the content for this presentation comes from The Macroeconomy Today by Schiller and Gebhardt, published by McGraw-Hill Publishers. This is going to be an intro to Chapter 11. Chapter 11 is the chapter on fiscal policy, and what we're going to do is talk about some topics from chapters 4, 9, and 10. In this course, we're not covering all of chapters 4, 9, and 10, but we are going to review some of the topics that are important to the understanding of fiscal policy. That's what we're doing in this video. First, taxes from Chapter 4. Taxes are monies collected by government organizations. And government organizations, just like any other organization, they have fiscal plans. And any fiscal plan has two sides to it, the revenue side and the expenditure side. On the revenue side, this is the inflows of money. These are collected in the form of taxes. The expenditure side, these are the outflows of funds. These are purchases of goods and services that the government is undertaking, and paying for resources used, paying all of government salaries, for example, and paying for any other resources that they're using. And also transfer payments are a big part of especially the federal fiscal plan. So in the federal government, this would be, for example, Social Security payments. These are transfer payments which must be funded out of the fiscal plan in any given year. Now you notice I didn't talk about borrowing. Borrowing is an inflow of money in any year where there is a budget deficit. A budget deficit is when the outflows are greater than the inflows. Our federal government has a budget deficit almost every year, and so they must borrow the money, which becomes the inflow that balances the budget. And we'll talk about how that works when we get to fiscal policy. Now, if you recall the GDP equation, GDP equals C, consumption, plus I, investment, gross investment, plus G, government expenditures, plus net exports. Well, that G portion of GDP has actually shrunk as a percentage, and private expenditure, which would be C and I, have grown. And most of the growth in federal spending is from increased transfer payments, but overall, G as a percentage of GDP has declined. When we looked in Chapter 5 at the year 2018, G, government expenditures, was 17.1% of GDP. Just a few years earlier, I believe 2 years earlier, it was 19.5%. Now you'll see it vary as the economy goes through cycles. When there's a recession, consumer spending decreases, so C goes down as a percentage of GDP, and that alone makes G increase, and investment also goes down during a recession. So that was part of the change, but still, overall, long-term, G has been decreasing as a percentage of GDP. This pie chart shows how federal income tax revenue breaks down into the different categories. You can see the largest piece of the pie comes from individual income taxes that individuals pay. Social Security taxes make up 35%. And so individual income taxes plus Social Security taxes make up 85% of all federal tax revenue. And then corporate income taxes, remember in Chapter 5 I told you that we lowered the corporate income tax rate in 2018 from 35% to 21%. That was a 40% decrease in the tax rate, so that's a 40% decrease in corporate income taxes collected. So that made the whole pie shrink, and corporate income taxes as a percentage of the pie shrink from 10% to 7%. And then all other taxes are sort of bundled together in the remaining 8% of the pie. Our tax system in the United States is a progressive tax system, which means that the larger your income, the bigger percent you pay in taxes. Although I will say that our tax system is considered only moderately progressive. Other similar economies in Europe, for instance, have a more progressive tax system. So the percentages increase faster the more you make in those economies. And you can see in 2020, here are some, this is not all of the tax brackets, but it kind of gives you an idea. If you make $9,875 or less, so you'll be working part-time, 10% of your income is tax. 10% is what you pay in income taxes. If you make between $40,000 and $85,000, so this is a large percentage of our labor force, you pay 24%. And if you're lucky enough to make $518,400 or more, you're paying 37% in federal income tax. But as we know, the richest people in our economy, their income is not earned income taxed this way. It's investment income, and they pay capital gains taxes, which is a lower tax rate. This is one of the problems with our tax system. Remember that Social Security taxes make up 35% of all federal tax revenue. And that's because 7.65% of your pay goes to Social Security. That goes to the Social Security fund. And your employer matches that. So that means that the equivalent of 15.3% of everyone's income is going into the Social Security fund. You can see why that would amount to 35% of all federal tax revenues. That's $1.3 trillion in 2020. Now, it's capped. You only pay Social Security taxes on the first $118,500 of your income. So what this means is if you make lots more than that, the percent of your income that goes to Social Security taxes is quite small. So I'm going to figure out right now, you could do it with me, pull out your calculator. We're going to figure out what Warren Buffett pays in Social Security taxes. He pays 7.65% of $118,500. So let's see, that will be 118,500 times 0.0765 equals Warren Buffett pays $9,065.25 every year in Social Security taxes. That is a very, very small percentage of his income. Everyone that makes $118,000 or less pays 7.65% of their income. So in that way, it's a regressive tax system. It's the opposite of being a progressive tax system. However, the benefit is also capped. So Warren Buffett makes whatever that maximum would be in Social Security benefits when he retires and starts collecting, if he ever does. And I can't tell you what that number is, but whatever the top is what he makes. Now, corporate taxes, these are taxes paid by businesses on corporate profits. And, it says here that corporate profits are small compared to consumer income. Well, that's true. Consumer income is 47% of income taxes collected by the federal government, whereas corporate profits are only 10%. But 10% is still significant. And again, we did lower the tax rate from 35% to 21%. That happened under the Trump administration. Joe Biden has said he would like to raise that back up to 28%, somewhere in between 21 and 35. So we'll see if that happens. Excise taxes, this is usually imposed by a state government. This is taxes on a specific product, such as liquor, alcohol, gasoline, cigarettes, firearms. Have you wondered why gasoline prices vary so widely as you cross state borders? Because different states apply different amounts of excise taxes to gasoline in their states. Now, there's one characteristic that each of these has, or maybe there's two, that makes them good targets for excise taxes. This is something we talk about in the microeconomics class. And you haven't heard this term yet, but they each have inelastic demand. The price elasticity for these products is inelastic, meaning people are not very sensitive to price increases. when you apply an excise tax, you're increasing the price. People tend to underreact to the price increase. Suppose you add a 5% tax, that would be a big tax, on gasoline, an additional 5%. People will react by buying less gasoline, but not 5% less, maybe 1% less, because gasoline is a necessity. What about liquor and cigarettes? Well, it's the addictive qualities of those products that make people less price sensitive than they would be for luxury items, things that are not necessities. So the overall effect of this is when they add the tax, the excise tax, because the demand is inelastic, industry revenues actually increase, they don't decrease. And of course the increase goes to the government in the form of these taxes. Now, property tax, this is a primary source of income for local municipalities, local school districts, local counties. Sales tax is a major source of income for states that do have a sales tax. Some don't have sales taxes, so they must collect their tax revenue in some other way. Now in Chapter 9, let's talk about what people do with their money. They spend some of it, they save some of it. Consumption, we know, in economics means when a consumer spends money to purchase a product and use it. Once they've done that, they have consumed that product. That's the way we use this, right? Well, we know that, again, from our GDP equation, GDP equals C plus I plus G, and then there's an adjustment for net exports. Consumption is about 2/3 of GDP. I believe it was 68% in 2018, the year we looked at in Chapter 5. Well, after you're taxed, then you're left with disposable income. This is your take-home pay. So then your take-home pay is divided into consumption and saving. You spend some percentage of your take-home pay, and you save the rest. And can you guess roughly what the savings rate is? The savings rate would be the percentage of disposable income that people save. What do you think the savings rate in the United States is roughly? It goes up and goes down depending on the business cycle, but take a guess. Now let's talk about the average propensity to consume. The word propensity means tendency, kind of like the average tendency to spend money, to spend your income is what this is measuring. For the average person in a given economy, the average propensity to consume is the percent of that person's income that they spend. So the remainder of it then they save. So there's also an average propensity to save. One plus the other, if you're doing this in decimals, one plus the other would equal 1. Or 1 plus the other as percentages would equal 100%. So the average propensity to consume, again, is the percentage of a person's income, disposable income, the money they have to dispose of, that they spend on consumption. In 2019, in the U.S., our average propensity to consume was 0.92. That was pretty good. This goes up and goes down depending on the business cycle. Believe it or not, when the economy improves, people spend more of their income, the opposite of what you would think. And then when the economy is doing more poorly, they usually save more of their, as a percentage of their income. They sort of correct their bad habits and pay off their credit cards when it's a recession. But in 2019, this was a pretty good year, 0.92. So that means the average propensity to save was 0.08. People were saving 8% of their disposable income. You should be saving 15%. As a goal throughout your lifetime, you should be trying to save 15% of your, now this would be your gross income, and this is what you would use a 401k for. You would have, usually your employer would contribute some percentage, and that's your retirement benefit. Maybe it's, let's say, 8%. You should put another 7% in. That comes out before you pay taxes. That's the way a 401k works. Then you have 15% going into your long-term retirement fund, your 401k. But the average American is saving 8%. More than 50% of Americans are saving 0%. So the average ends up being 8%. Now, as it turns out, for our purposes in discussing fiscal policy, average propensity to consume is not all that important. What's more important is marginal propensity to consume. Marginal propensity to consume. What this means is, this is the percentage of marginal income that people spend and the remainder gets saved. This is more important for the current topic, which is fiscal policy, because when the government implements fiscal policy, they are creating marginal income. People have some amount of income, and so say the government wanted to stimulate the economy. They would do something to give people extra income to spend. They would try to create marginal income, and we're going to learn this later. They would do that either by decreasing taxes. That gives you more take-home pay, right? And then you would spend that. That's marginal income that you didn't have before the tax cut. Or maybe the government themselves spend more money, and that becomes extra income for whoever it's being spent on. And then we're going to learn how that multiplies through our economy. But in either case, a certain amount of marginal income is being created. So if you were to get, let's say, a $1,000 tax credit, and this was done through fiscal policy, how would you spend that? Do you think you would save a larger percentage of that than you're currently saving on your total income before this tax credit? Or would you spend more of it? So, in other words, how different would your marginal propensity to consume be from your average propensity to consume? And can you guess? For the average American? Actually, they save more of marginal income than they save of their total income. And so, again, marginal propensity to consume would be the percentage or proportion of marginal income, some change to your disposable income, that you spend. And then there's also marginal propensity to save. That would be the percentage or proportion of any marginal income you would receive that gets saved. So there's a relationship then between marginal propensity to consume and marginal propensity to save. If we're expressing them as proportions, then marginal propensity to consume plus marginal propensity to save must equal 1, right? Maybe it's 75% of marginal income gets spent. Well, then it would be 0.75 plus 0.25 equals 1. So that means rearranging marginal propensity to save equals 1 minus marginal propensity to consume. And that will be a useful relationship, which I'll show you shortly. Now this leads us to the multiplier process, which is a topic from Chapter 10. Now the multiplier process is very important to understanding how fiscal policy plays out when it's being implemented. And this diagram is showing you the multiplier process sort of working in reverse. Before I get to this, let me explain it this way. Suppose the government is implementing fiscal policy, and a simple example of how to do this would be to lower everybody's taxes by $1,000. In other words, give everyone a $1,000 tax credit. So you get $1,000 of the taxes you've already paid during the year refunded to you when you do your tax return. Okay, so everybody's receiving a $1,000 tax credit. So if you're the average American, what do you do with that $1,000? Well, I'll tell you what I'm doing. And let's say that the marginal propensity to consume is 0.7. Okay? The marginal propensity to consume is 0.7. That means the average American spends 70% of any marginal income he or she receives and saves 30% of it. All right? So here's how it works. So I get my $1,000 tax credit. It comes in a tax refund check from the federal government. And I don't know about you, but what I'm going to do is I'm going to go to Gary's House of TVs in downtown Taylor. That's in the shopping district. And I'm going to buy that flat panel TV that I've had my eye on, because this is money that fell out of the sky. And I wasn't expecting it, but now I have it. and I'm the average American. I'm going to spend 70% of that $1,000 and save 30%. So I'm going to save $300 of it and spend just $700 of it. That's perfect though, because this TV costs $700. So I do that. I spend $700. That's just the first step. Now, Gary's House of TVs has $700 of marginal income that they were not expecting before. And so Gary takes his wife on a weekend trip to Cape Cod, and they stay in their favorite bed and breakfast for 2 nights and spend $490 on that. So this $700 of marginal income that Gary of Gary's House of TVs has, he's going to save 30% of that and spend only 70% of it. So he's going to spend $490 of the $700 and save $210. I'm doing this math in my head. So he does that. Now, the Cape Cod bed and breakfast has $490 of marginal income that they were not expecting, that would not have happened if not for this fiscal stimulus. And they're going to spend 70% of that $490 of extra income they now have, because Gary and his wife are staying in a vacant room, and that's $343. So you can see that there are successive rounds of spending that diminish over time, but there are successive rounds of spending. There's the initial round of spending that's directly caused by the government, the fiscal stimulus, and then there is additional rounds of spending that take place in the economy over time. Now this takes maybe weeks, maybe even a couple months to play out fully, but the government needs to know about this, because when there's a recession, they're looking to stimulate the economy, to increase spending in the economy. They don't need to fix the whole recession by spending all the money themselves. They just have to cause the initial round of spending that will then set off successive rounds of spending, which again diminish over time, but need to be accounted for. You don't want to spend too much. You don't want to spend too little. So you need to be able to account for this multiplier process. That's the way it works with fiscal stimulus. And this would be called for when we're in a recession. So how might we have gotten into the recession? Well, now let's take a look at this diagram. This is showing you how it may have been caused. And let's start with step number 1. Across the whole economy, investment drops by 100 billion. Suppose that were to happen. All right? That is one part of GDP, right? The GDP equation is C plus I plus G. This is gross investment. This is businesses spending on capital goods, adding to their facilities, modernizing their facilities, buying new equipment, that kind of thing. Well, if companies decrease their spending on investment in any given year by, and in this case we're saying $100 billion, that affects product markets, because that's part of investment goods are sold in product markets, right? Capital goods. Well, let's follow the diagram now. We're at step 2. That means there's $100 billion in unsold investment goods, capital goods in the product market. That affects the business firms that sell capital goods. So construction firms are affected. So how do they respond to this? Well, if there's unsold goods, they're not selling everything they're producing, they have to cut back in employment or wages. They lay off people, or maybe just may freeze all wage raises, probably lay off people. Now that affects factor markets, such as labor markets. Income is reduced by 100 billion in factor markets. All right, that affects households, because some people work for the companies that produce capital goods and now they're laid off. So there is $100 billion of a decrease in household income. So this is negative marginal income, right? Instead of increasing household income, it's being decreased. All right? Now in this case, we're being told marginal propensity to consume is 0.75. People spend 75% of marginal income. And if there's negative marginal income, this means that they decrease spending by 75% of the decrease, and they decrease savings by the remaining 25%. All right? So there's a decrease of $100 billion in household income. This means that it's going to increase consumer spending by 70% of that, 75% of that, 75 billion, and it's going to decrease savings by 25% of that amount, and that would be 25 billion. Well, let's follow consumption. So consumption goes down by 75 billion. This is households spending on consumer goods and services now. It's affecting all of those markets in the second round of spending decreases. All right, so there's a decrease of spending in product markets of $75 billion. Now, any company that produces and sells consumer goods and services is affected. There's a total decrease in the economy now of $75 billion of revenue in consumer goods and services. It affects those business firms. They need to find ways to cut employment or wages, laying off workers. This affects, again, factor markets. Now people who work for companies that produce consumer goods and services are unemployed. And that's happening in a factor market, in a labor market. So incomes now are reduced by $75 billion. You can see how this is working now. So this happens in reverse also. So there's $75 billion of decreased household income. Now people are going to cut their spending by 75% of that amount and cut their savings by 25% of that. So consumption goes down by $56.25 billion, 75% of 75, which affects product markets. And you can see this will continue and diminish over time, but this is the multiplier process, showing you that when there's a decrease in spending in the economy, in this case caused by businesses, it gets multiplied. Here's how fiscal stimulus plays out. There's an initial increase in spending, which is the stimulus, which is caused by the government, either lowering taxes or themselves spending more money. So there's some amount of initial stimulus that makes the aggregate demand curve shift to the right some. When the aggregate demand curve shifts to the right, we move up the supply curve, the aggregate supply curve. This is making prices rise some, right? And that is increased production because GDP has increased, because the equilibrium point has moved to the right horizontally. Well, if we're producing more GDP, that means there's more income in the economy, which people have to spend. So people will spend some percentage of that increase in income. And this further shifts the aggregate demand curve to the right. Consumer spending increases and go back to step 2. Inventory depletes, and that's a signal to increase prices. So this whole thing, this is just sort of explaining in steps the circle that we went through on the prior slide. This is the multiplier process happening. Sometimes the government wants to decrease spending. You increase spending, fiscal stimulus, when it's a recession. If you're having the opposite problem means high inflation, then you want to restrain spending. Fiscal restraint is when you're looking to decrease spending in the economy. And so they'll cause some sort of initial decrease in spending by raising taxes, for example, or by themselves spending less money than they would have normally. That's a decrease, an initial decrease in spending. That leaves unsold output, production is cut back, that affects people's wages. This is the process we just went through in the diagram, right? That decreases people's incomes, and then people spend less money in product markets, and then that becomes less revenue for businesses, and then those businesses have to decrease employment costs and lay off people, and that further decreases consumer income and consumer spending, and this goes in a circle, right? And each, again, successive round, it diminishes some. So how much multiplying happens? Let's go back to fiscal stimulus. So the government is going to cause some amount of increased spending initially in the economy that then gets multiplied through these successive rounds of spending, right? How much does it get multiplied? Well, it depends on the marginal propensity to consume. As you can imagine, Suppose the marginal propensity to consume is 0.9. People are spending 90% of marginal income that they receive. Well, there's going to be a lot more multiplying than if the marginal propensity to consume was 0.5, 50%. Let's think about that. Well, let's again go back to the simple example of the government plans to stimulate the economy by giving everybody a $1,000 tax credit. So everybody has $1,000 of marginal income. Well, if you're going to spend 90% of that, then you're going to buy the $900 TV, and you're going to take the deluxe room, the TV shop owner, when he takes his wife to Cape Cod, and he gets an $810 room instead of a $490 room. And then that's $810 of marginal income for the Cape Cod bed and breakfast owner to spend 90% of. Well, compare that to if the marginal propensity to consume was 50%, 0.5. Well, I get my $1,000 tax credit and I spend only 500 of it because I'm saving 500 of it. And then the TV shop owner is going to spend just $250 of that $500 of marginal income. It diminishes much more quickly. There's much less multiplying. So the larger the marginal propensity to consume, the greater the multiplying that happens. So we use the multiplier, which is 1 over 1 minus the marginal propensity to consume. And since we know that denominator, 1 minus marginal propensity to consume, is also equal to the marginal propensity to save, an easier version of this would be the multiplier equals 1 over the marginal propensity to save, right? As I said, if the marginal propensity to consume is smaller, the multiplier is smaller. If the marginal propensity to consume is larger, then the multiplier is larger. There's more multiplying that happens in the economy. Here's an example. If the marginal propensity to consume is 0.9, you can see that the multiplier then would be 1 over 1 minus 0.9. Again, I prefer to use, to figure these out, multiplier equals 1 over marginal propensity to save. Because the kinds of examples we're going to be doing, you could think of the marginal propensity to consume and save in terms of fractions. So 0.9 would be 9/10, right? And what would be the marginal propensity to save as a fraction? 0.1 or 1 over 10. Well, let's use that version of the multiplier equation. 1 over marginal propensity to save. 1 over 1/10 is 10, right? Suppose the marginal propensity to consume was 0.75. What is the marginal propensity to save? 1/4, right? What is 1 over 1/4? 4. So the multiplier then is 4. What if the marginal propensity to consume is 0.5, 1/2? Well, then the marginal propensity to save is 1/2. What's the multiplier? 1 over 1/2 or 2. See how it's easier to do these if you could use the 1 over the marginal propensity to save equation for multiplier. Here's another one. If the marginal propensity to consume is 0.8, as a fraction that will be 4/5, right? What is the marginal propensity to save? 1/5. So the multiplier then is 1 over 1/5 or 5. When the government is stimulating the economy, they are causing an initial change in aggregate spending, an initial shift in that aggregate demand curve, right? So this equation in the box reminds you that then you need to multiply that by the multiplier to come up with the total change in spending. So if it's stimulus, the total change in spending is an increase. The example you see below the box is a decrease in spending. And like in the diagram when we showed that there was a decrease of $100 billion in investment spending, if that's what happens in the economy, the amount of total decrease in spending depends on the multiplier. The multiplier we used was 0.75 in that example, but what if the marginal propensity to consume was 0.9, then the multiplier would be 10, right? Then the total change in decreased spending in the economy after all the multiplying happens in reverse would be minus a trillion, minus 1,000 billions, right? If the multiplier were 5, so this would be if the marginal propensity to consume were 0.8, right? That would make the multiplier 5. If the multiplier were 5, then this initial decrease in spending of $100 billion would become multiplied and end up being minus 500 billion, and so on. So now we're ready to talk about fiscal policy, and we will do that in the Chapter 11 video. I'll see you there.